Good morning and welcome to the webinar, Divorce and Taxes. Actually, it'll be more like divorce and business taxes today. This is Roger Royse, the founder of the Royse Law Firm, a business, corporate, and tax law firm with offices in Northern and Southern California. Today we're going to discuss tax aspects of divorce and emerging issues, including the tax treatment of spousal support and the division of property, such as residences, equity compensation, and retirement plans. We'll discuss issues arising in connection with the division of business interests, including passive activity losses, net operating loss, capital loss, and S corporation losses. With me is my guest, Jason Crowley. Jason is the founding partner of Divorce Capital Planning, a Silicon Valley-based firm specializing in divorce financial planning and analysis for high asset dissolutions. He provides guidance, education, support, and analysis of complex financial issues to help clients and their attorneys navigate this difficult transition. Jason is one of the few financial professionals who holds a chartered financial analyst, certified financial planner, and certified divorce financial analyst credentials. He has a bachelor's in business economics from University of California, Santa Barbara, where he graduated summa cum laude. And I, of course, am Roger Royse, founder of the Royse Law Firm, and I will be participating in this webinar. Now, before we start, a few housekeeping items. You will notice on your screen there is a dialog box for questions. As we go through our presentations, you can go ahead and type your questions in that box, and that will be submitted to us. And at the end of the presentation, if we have time, we'll go ahead and answer your questions. This webinar is being recorded. It will appear on our site, royseuniversity.com. It will also appear on the Royse Law YouTube site and be available in the iTunes store as a download. So with that, why don't we go ahead and get started? Next slide. So I'm going to start off here, and I'd like to just hit a few topics relating to the business tax issues that are related, that come up in marital dissolution. I want to talk about issues with respect to transferring assets in a dissolution, some of the tax liabilities that are built into those assets and how those are handled, dealing with net operating losses, capital losses, the effect of passive activity loss rules, some real sleeper issues, S corporation, suspended loss, and dealing with attorney's fees. Next slide, please. So just to make sure we're all on the same page before we get too far into this, let me just tell you what one of the big tax stakes or big tax issues usually is in connection with these transactions, and it's one of characterization. Now, there's different types of payments that can be made in a marital dissolution, and they're characterized different ways. So general rules, alimony, typically taxable to the recipient, deductible to the payor. Child support, neither taxable nor deductible, although there are some issues as to who can claim dependency exemption. And usually that exemption goes to the spouse who has physical custody of the child for the greater number of overnights during the calendar year, although a custodial spouse can waive their rights to the exemption. Property division. Property divisions are typically not taxable if they fall under 1041, which we'll talk about in a minute. So usually the distinction is, first of all, is it a property division payment or is it alimony? And secondly, is it property division or is it a sale or an exchange? And then finally, the treatment of dependents. Now, alimony is, to be alimony, a payment has to meet all of the following characteristics. It has to be made in cash, and this could be a third-party payment on the spouse's behalf for something like medical expenses or mortgage payments or income tax, or even legal fees, as we'll talk about in a little bit. The instrument, and that means the settlement agreement or the decree, does not designate the payment as not being alimony. The spouses cannot be members of the same household when the payment is made, and there's no liability to make any payment after the death of the recipient spouse. In other words, alimony ends on death. The payment's not treated as child support, and the spouses don't file a joint return. Those are the rules on alimony. With child support, the separation instrument must generally clearly state a fixed amount for child support, otherwise that amount would be treated as alimony. And we do have a case on this, Lawton versus Commissioner. It's a tax court memorandum decision that requires that child support be fixed by the terms of the divorce or separation agreement. And finally, there is a recapture rule under Code Section 71F that prevents settlement payments from qualifying as spousal support if the individual paying the support in some cases must recapture some of the money paid in that year's taxable income. And we'll get into that in a little bit. All right, next slide, please. Let's start with transferring assets. Now, typically, a transfer incident to a divorce, that's Code Section 1041, is treated as a gift, meaning that there's no tax on that transfer, and the transferee takes a carryover basis. Spouses are eligible for a 1041 transfer, and doesn't have to be pursuant to a divorce in order to get this treatment. You know, any transfer between spouses is tax-free and enjoys a carryover basis treatment. But under 1041, for purposes of our discussion, we're discussing transfers incident to a divorce, meaning that the transfer must either occur within 1 year of the date the marriage ceases or be related to the cessation of the marriage. Oftentimes, you'll see transfers to a trust for the benefit of an ex-spouse, and that too can qualify under Code Section 1041A. Now, what doesn't qualify, an ineligible transfer, would be a transfer, for example, to a third party in relation to someone's divorce. In other words, property just gets jettisoned out to somebody else. A transfer to a non-resident alien doesn't qualify under Section 1041D. And if you think about it, you can sort of see why. I mean, at that point, the U.S. is losing tax jurisdiction over the property. It's its last chance to tax that transaction, so it catches it on the way out. If the transfer is not incident to a divorce, meaning that it occurs more than 1 year after the marriage ceases and is not related to the cessation of the marriage, or if the transfer is of property in trust and the sum of all the liabilities assumed and the liabilities on the property exceed the adjusted basis of all the property transferred. That's our general tax rule, liabilities in excess of basis. Now, if we have an ineligible transfer, what we have is gain or loss recognition. Where this comes up oftentimes is where parties want to have a transfer under 1041 and not have any tax on the transaction, and they may end up, however, because it's low basis property, they end up inadvertently being thrown into a sale where tax is recognized. The common scenario is where a spouse gets a right of first refusal on a house. So a house gets transferred down the road back to a spouse. So in other words, part of the marriage separation agreement is that you can live in the house, ex-spouse, but if you ever sell it, I have the right of first refusal. Years down the road, the property, that right of first refusal is exercised. And then we have this issue, well, was that incident to a divorce or was it not? And people are oftentimes surprised to find out that it's not, and the spouse gets taxed on it. Let's talk about houses for a minute. So we have in the code a principal residence exclusion under Section 1241. That's an exclusion of up to $500,000 of gain on a residence, on the sale of a taxpayer's primary residence, if during a previous 5-year period the property was owned by the taxpayer and has been used by the taxpayer as their principal residence for 2 or more years in the aggregate during the previous 5 years. That's $500,000 total exemption if the parties are married, or $650,000 if they're single. This applies if either spouse meets the ownership requirement and both spouses meet the use requirement, and neither spouse has made another 121 sale within the previous 2 years. So here's the scenario. Can we use 1041 to transfer the primary residence tax-free to a spouse or a former spouse? And the code addresses exactly this event. In this case, the transferee inherits the transferor spouse's ownership history. So in other words, if the transferring spouse owned it for 4 years, the transferee is deemed to own the property for 4 years. And if the spouse or former spouse is granted use of the primary residence through the divorce or separation instrument, then that use counts towards the other spouse's principal residence. Now, there's a sort of interesting issue that comes up in this scenario is when we have a separation agreement, the primary residence is transferred to a spouse, they use it, They all meet the 5-year requirement, and then the spouses remarry and the house gets sold. And there's a real question here as to, depending who you talk to, as to how much exemption there is. So in that example, does the spouse who sells the house, do they get a full $500,000 exemption on the sale because now they're remarried, so remember it's joint, or do they get $250 because that's their half basically of the house? And the spouse that transferred the property, do they have another $500,000 exemption on their own house? So the question is this an exemption that applies on a per house basis or on a per taxpayer basis? And like I say, that's somewhat of a question because you'll find commentary and authority and opinions going kind of all over the place on this issue. And I will just raise that as an issue and tell you that my view is that it is a per taxpayer limitation. So there should be additional amounts available, although there are commentators who believe that is a per property limitation. So I just want to flag that for you. Inherent tax liabilities. So remember what I said about transferring property in a 1041 exchange. It's just a non-taxable transaction. It's a gift. We get a carryover basis. And because the carryover basis rules apply to this property, a lost property can be worth more because it has a built-in tax loss, right? And a gain property can be worth less because it has a built-in tax liability. In other words, when the transferee spouse is going to sell that property later, they take that low basis, high gain, they're going to pick up a tax liability. So the true value of that property really requires calculating the property's inherent gain or loss, right? So if we have Blackacre that's got a basis of $1 million and a fair market value of $500,000, in a way that's worth more than Whiteacre that has a basis of $100,000 and a fair market value of $500,000, because Whiteacre is going to generate a tax gain at sale that's going to be taxed. California only heeds this principle, and they only take into account those inherent tax liabilities if one party would suffer immediate tax consequences from an expected sale of property or from the transfer itself, and that's the marriage of Fonstein. It's a 1976 case, and that's the case of a partner at a law firm, in fact, who, in the equal division of property, the trial court adjusted his law firm partnership interest downward because any payout to him would have been a taxable transaction. And the court reversed and said, no, there's no indication that he intended to withdraw from that partnership and take those amounts. So it's a little bit of a disconnect in California on the economics of that transaction. But it's good for parties to know that, just to understand that what they're getting might come in with built-in liabilities. Next slide, please. So let's talk a little bit about transfers of business interests, which could be interest in an LLC, interest in a partnership, or interest in an S corporation or even a C corporation. Now, net operating losses. Net operating losses are typically allowed. That's a loss from a business, and it's typically allowed with respect to businesses in which a party has materially participated, and we'll get to that in a minute. Net operating losses can typically be carried back 2 years, sometimes 3, and forward 20 years. At divorce, net operating losses are allocated between the parties. So if a business is divided, the net operating loss attributable to that business will be divided as well. And each spouse can carry over his or her share of the joint NOL, net operating losses, to their separate returns. And the authority for that is Huckle versus Commissioner, Tax Court Memorandum Decision. Capital losses, similarly, are allocated between the parties. Now, capital losses are different than net operating losses. They can only offset capital gains, and the tax plus $3,000 a year ordinary income, $1,500 if filing separately, and it may be carried forward indefinitely. So you'll find lots of people in this valley, especially those of us who survived the dot-com, who have net operating losses that last a long time. Okay, at divorce, the rule is that if a capital loss is generated on a joint return, it may be split, the carry forward gets split on divorce. All right, and it depends on how it was generated. So now, if the capital loss was generated through separate activities, then that carryover that the parties are splitting up is going to be allocated to each person based on their individual net long-term or short-term capital loss for the preceding year. So it's a little bit complicated. On the other hand, if that capital loss is generated through a joint activity, then it will just be split evenly. Okay? Thirdly, passive activity losses. Passive activity losses typically follow the asset. All right, and a passive activity, as you recall, this is an activity in which a taxpayer, it's a business activity for trade or business or for profit activity in which the taxpayer does not materially participate in that trade or business. Generally, passive activity losses are only deductible from passive activity gains. So usually in tax planning, we group our income and losses into three categories. They're either active trade or business income or losses, they're passive activity gains or losses, or their investment income or losses. So passive activity losses will sit there in a suspense account and be used against passive activity gains or be taken as loss when the taxpayer disposes of all their interest in the passive activity. So they follow the asset on divorce if the assets are divided in kind, or they increase the transferee spouse basis in the asset, so they're not deductible, but they increase basis so they can be used to offset gain when the activity is disposed of if that asset is transferred to one spouse. Okay? Now, S corporation losses, that's the exception to these rules about transfers of passive activity losses. And S corporation, as you know, is taxed as a pass-through. So as opposed to a C corporation, which pays its own tax on income, and then the shareholders are again taxed when that income is distributed out, an S corporation is merely an information reporting vehicle. So the income is passed through and taxed on the returns of the shareholders. So if an S corporation generates losses, those losses are deductible to the shareholders to the extent of their basis in their S corporation stock. To the extent that the losses exceed the shareholders' basis in their stock, and basis is typically cost, increased or decreased by income, loss, and distributions, and to the extent that loss exceeds basis, which very often happens, that loss is held in a suspense account, and it's suspended. And it is not allowed as a deduction until that shareholders has basis in the stock that would trigger the loss. That's an S corporation suspended loss. Okay, it can be carried forward indefinitely. And oftentimes in tax planning, you'll see people stuffing S corporations with cash just so they can trigger losses that are sitting in suspense. Now, suppose you have that situation. You've got an S corporation, it's got these suspended losses, and it gets divided up or it gets transferred in a divorce. So normally, those suspended losses will generally expire when somebody transfers S corporation stock. It's kind of a trap and a problem in our typical planning when we start out as an S corp and want to be a C corp down the road. But there's an exception to this when you have a transfer incident to a divorce. In a case of a divorce, suspended losses attributable to the transferor's shares are not transferred when such shares are transferred incident to their divorce. So that's the S corporation exception. You'll find it in Private Letter Ruling 955-2001. I want to talk a little bit about some other issues here. Number one has to do with the allocation of income and loss on S corporations and LLCs. And this comes up whether it's in divorce or whether it's in general business tax planning. It's a real sleeper, it's a real gotcha. It catches a lot of people in a lot of different scenarios because it just doesn't seem to be on everybody's radar. Keep in mind, remember what I said, these entities, S corporations and LLCs, are pass-throughs. That means the owner of the entity has to pick up their share of the income. So suppose that we have a division or a transfer of an interest of a business and a transfer of an interest in the middle of the year. All right, well, with an S corporation, absent another election, S corporation income is allocated on a pro rata basis based on a per share, per day basis, meaning that an event that occurs at the end of the year could affect the amount of income that gets allocated to the first day in the year. All right, So if a shareholder, on the other hand, disposes of his or her entire interest in an S corporation, they can elect to actually close the books on the date of that disposition. So you close the books and everything that's happened up to that date gets allocated among the parties. So things that happen after the date of disposition don't affect what's happened before. So every person who was a shareholder on any day during that year has to consent, however. This is something every one of these divisions should think about, contemplate, and deal with by agreement. Otherwise, you end up in a scenario where the spouse who transferred shares ends up getting a big fat K1 in March of the following year, reflecting a bunch of income that they never received. The LLC has a similar rule. The partners can agree to an interim closing of the books when an LLC member transfers that LLC interest to another member, and then they can prorate the partnership items across the taxable year. So they can do it either way in an LLC as well. A couple words about redemptions. The scenario is that we've got one shareholder. Suppose we have a husband and wife corporation. We're dividing the business. The husband has agreed to make a big payment to the wife in satisfaction of her interest, and he says, well, I'll just bootstrap it. What I'll do is I'll just have the corporation that we own just redeem her 50% out. She gets her cash, I get 100% of the stock, everybody's happy. So there used to be some real issues, and I guess there still are, around how that's treated. Is that a 1041 transfer? In other words, is it non-taxable to the recipient spouse because it's treated as though the husband has just paid her, gifted to her in property settlement? And if that's the case, doesn't the husband have to pick up the gain on the redemption because it's the corporation is making a distribution to satisfy his obligation? Or should it be treated as though it's a 1041 transfer directly from the corporation, so nobody picks up any tax? Regulation 1.1041-2 provides for an election to treat a redemption as a distribution to the husband or the wife as provided in a written agreement. So basically you can elect. It's either that husband, you picked up income on redemption, or wife, you picked up income on redemption. Okay, so 1041 will protect these parties, and you just have to agree if you're going to use a redemption strategy as to how to allocate that tax obligation, or a court will do it for you by determining whether it was the husband's fixed and unconditional obligation to pay the wife that's being satisfied. Next slide, please. So let's talk a little bit about legal fees, because I get this question a lot as to how are we going to deal with the legal fees that get paid in a divorce transaction. Are they deductible, first of all? So here's the general rule with regard to legal fees, just generally. Generally, legal fees are not deductible for personal advice, counseling, or the legal action in a divorce. All right, so if spouse hires a lawyer to object to a petition for alimony increases, you know, those typically not deductible. They hire a lawyer to set aside a prenup property agreement, generally not deductible. So here's the exception. If it's legal fees incurred in collecting or attempting to collect alimony, well, that is deductible. So husband goes to court to increase alimony payments or to collect arrears, that would be deductible. Or they go to, on the other hand, if they go to court to collect income that's non-taxable, like child support or temporary alimony, while there's still a joint return being filed, that's not deductible. So you can see the logic in this rule. Legal fees incurred to collect taxable items are deductible. Legal fees incurred to collect non-taxable income are not tax deductible. Now, oftentimes I get consulted on these matters with respect to tax advice, and my legal fees will relate to tax advice and tax consulting. And to be deductible, and that is deductible, tax-related fees are typically deductible, tax deductible. Now, to be deductible, however, my bill has to specify how much is for tax consulting and how much is for unrelated matters. So there has to be a very specific allocation. It's a matter of proof. And under Revenue Ruling 72-245, a time-based allocation is okay if it lists the customary charge in the locality for similar services and the results obtained in the divorce negotiations. There are some important exceptions to deductibility. No deduction typically for payment of the spouse's legal fees, even if the fees would have been deductible for that spouse, right? Because you're not paying your own fees, unless you can characterize those legal fees as alimony under those rules that we discussed before. Remember, it's the payee's obligation. It ceases on death of the payee. We avoid this anti-front loading problem that we had talked about, otherwise not deductible. And here's another important one that catches a lot of people. There's no deduction on these deductible legal fees that I described for any amount that is not in excess of 2% of the payor's adjusted gross income. So in other words, there's this floor of 2% of AGI. So with that, I'd like to turn the microphone over to Jason Crowley, who is going to talk a little bit more about issues that are very relevant here in Silicon Valley, treatment of stock options, treatment of equity, treatment of ISOs, retirement plans, etc. So Jason?
Thanks, Roger. So as Roger said, my conversation is really going to focus around a couple of important topics in this area. One being stock options and equity compensation, the other being retirement plans and deferred compensation. So to begin, why don't we start by just going over some of the key terms and dates, things that are really just definitions that you really need to understand in order to move on to some of the more complicated issues dealing with the division and valuation of stock options in divorce. So we have the grant date. That's the date that the option is granted to the employee. Another key date is the exercise date, and that date is when the option is actually converted to stock. So when the employee elects to exercise, i.e. purchase the stock option. The exercise price, also called the grant price, is the preset price at which the employer allows the employee to buy stock. And that price is set on the grant date. We also have the vesting date, and that is the date that the option may be exercised and all the restrictions are removed. Occasionally, especially in the Valley with some private companies, we have companies that will allow their employees to exercise early. Keep in mind that despite becoming exercisable, the vesting date will still be the later date when all the restrictions are removed. And that can present some complications when it comes down to determining the community and separate property interest in the stock options. Another one that's really important for tax purposes is called the bargain element. And the bargain element is the difference between the exercise price of the option and the actual price when it's exercised. So there are several types of equity compensation. One of those is restricted stock. Restricted stock is the stock granted to an employee that's subject to vesting restrictions. It's taxed when vesting restrictions lapse, and the income is equal to the fair market value minus the amount paid by the employee. In a very similar vein, we have restricted stock units, or RSUs. And these are very similar to restricted stock, really work in the exact same way. The only difference is that these are an unsecured promise by the employer to issue a set number of shares at vesting. The employee is taxed on the fair market value of stock at the date of vesting. I think the easiest way to think about both restricted stock and restricted stock units are that it's really like a bonus paid in stock instead of cash. So the employee, it's really taken out of the employee's hands. They don't make a decision to exercise or not. When they hit that vesting date, they're taxed on ordinary income based on the value at that date. Then the stock option piece, we have two types, non-qualified stock options and incentive stock options. Non-qualified stock options, you'll probably hear me refer to throughout as NSOs or non-quals, receive no special tax treatment, but they're not nearly as restrictive as incentive stock options. So really the key difference between non-qualified stock options and incentive stock options deals with the tax treatment and the transferability of those options. An employee stock purchase plan allows employees of a company to buy shares of stock at a discount. Typically, it's purchased at 85% of fair market value. There's no tax at purchase, and they have a required holding period that's similar to incentive stock options. We also have stock appreciation rights. Stock appreciation rights represent a promise to pay a bonus in cash or stock based on the increase in value of the company's stock. So these are basically like a phantom stock plan where there's no real stock there, but it's just a right to participate in the increase in the value of stock that may occur at a future date. So before we really dive into the division of stock options, I want to do a quick overview of the tax treatment of non-qualified stock options and incentive stock options. As far as non-qualified stock options go, these don't meet the requirements that incentive stock options have to meet to qualify for favorable tax treatment. So when it comes to ISOs and ENSOs, for both of those, there's no tax on grant. However, the difference is the taxable event for non-qualified stock options is generally the date the options are exercised and stock is purchased by the employee. One thing to point out, point of confusion that I see often with clients is they often confuse the terms exercise and sell. They often use the word synonymously or interchangeably. So I think it's important when someone says they've exercised stock options to really make sure that they are not using that as exercise and sell versus just exercise, which means to purchase based on the price. The employee, when employees are exercised their grants, they'll recognize income equal to the difference between the fair market value of stock at exercise and the price paid for the stock. This is reported on their W-2 as additional compensation income. Now, if those shares have not vested, they'll report income when shares vest. Another wrinkle deals with the Section 83B election, in which employees can treat shares as if they were vested. That's something just to point out. We're not going to spend a lot of time on that for these purposes, but something to be aware of for stock option planning really outside of the divorce process. And if stock is held, the employee will recognize capital gain or loss when it's sold for a subsequent increase or decrease in value. Moving on to incentive stock options, the real key difference between ISOs and ENSOs deals with the time of exercise. For incentive stock options, the exercise of the options will result in alternative minimum taxable income only. No regular tax will be recognized. If the employee holds the stock for the required time, they'll recognize capital gain income when sold for the difference between the sales price and the exercise price paid. Key feature is that this allows participants to receive capital gains treatment on the entire amount between the exercise price and the sale price of the stock. This is the big advantage over non-quals. It has the ability to convert ordinary income to capital gain, thus paying lower rates. And income is recognized in the year of disposition, assuming that they meet the required holding periods. So the way that this works is essentially you're making this decision with ISOs, assuming that there's going to be a large appreciation in the stock price, and you have the ability to convert the ordinary income to capital gains. Now, there are what's called disqualifying disposition, which occurs when the stock is sold or transferred prior to expiration of the required holding period. So, for example, if you exercise and sell on the same day, and this is what's called the same-day sale, then you're going to lose your incentive stock options are going to lose their status as an ISO, and the option stock transaction will be taxed as a non-qualified stock option. The only difference is the ordinary income will be recognized in the year of disposition if that happens to be different than the year of exercise. The disqualifying disposition deals with anything that occurs within 2 years from the date of grant or within 1 year from the date of exercise. Also along these lines, incentive stock options are not allowed to be transferred to another party, or that will also be deemed as a disqualifying disposition. And that comes into play in a divorce when transfer to a spouse can be deemed as a disqualifying disposition. So something, a red flag to be aware of. So now let's jump into the division of stock options. There's really a couple key questions when dealing with stock options in a divorce. The first one is, are we going to value or divide the stock options? And the second one is, if we decide that we're going to divide them, how are we going to get the stock options to the non-employee spouse? And what are the tax implications of doing so? So for the purposes of this conversation, my focus is really going to be more on dividing stock options, but first a quick overview of valuing. A couple things to keep in mind. One mistake that we see all the time is a failure to include the time value of stock options. So you have a situation where the current price of the stock is equal to the exercise price or below, and so these options are underwater, they're not in the money, and there's no intrinsic value in these stock options. However, if there's still a period of time, and the longer the period of time, the more value there is, until the expiration date, these shares have the ability to rise in value, so there is value there. Determining the actual value is a complicated issue. There's several different methods that can be used, including Black-Scholes methodology, as well as binomial lattice model. And so these are things to keep in mind. It becomes really difficult, especially with private companies, but something to consider if there is going to be a buyout or offset of options, especially if you're representing a non-employee spouse or working with a non-employee spouse, to make sure that you include some component for time value. When it comes to dividing stock options, the court has a great degree of discretion in selecting an equitable method of allocating or apportioning the community and separate property interests in stock options. A few of the more popular formulas used in these calculations include the Hug method, Nelson method, and Harrison method, which is really just a variation of one of the above. Now the issue is that, kind of like a pension plan, stock options are something that's considered property for the purposes of dividing up the marital estate, but you also have components of income. Because when your stock options are exercised and sold, there can be tax consequences. So the question becomes, who has to report, if we do divide stock options, who has to report and pay the compensation income? And looking back, it used to be that this was really a difficult issue in terms of how do we allocate the income, and there really was a lack of guidance. Over the past several years, there's been a number of revenue rulings that have come out which have provided authoritative guidance on these issues. A couple of the key revenue rulings are Revenue Ruling 2002-22 and 2004-60. These revenue rulings address how vested, non-qualified stock options can be divided and who pays the tax. And because these are revenue rulings, we can rely on them as authoritative guidance on the handling of taxation of vested non-quals in divorce. So the way this works is the exercise of vested non-quals by the non-employee spouse will be taxed to that spouse. Similarly, this parallels the treatment from a non-qualified deferred compensation plan to a non-employee spouse. So the tax treatment on both of those parallels each other top to bottom. The employee spouse, key thing to keep in mind is the employee spouse will always be responsible for Social Security and Medicare taxes. That's something that can't be allocated to the non-employee spouse because it's unique to the individual. So the way that this works is the FICA withholding is going to show on the employee's W-2. And moving along to next slide, we have what happens to incentive stock options, or what happens if you have unvested non-qualified stock options. That was still a big question that the revenue rulings didn't address. Since that time, there's been a series of private letter rulings that seem to indicate the IRS's intent to have the parties each report his or her share of the stock option exercise. So essentially, the non-employee spouse is stepping into the shoes of the employee spouse. This is just like the treatment that we talked about earlier. Key thing to remember here is these are private letter rulings, which means they're based on the specific and unique circumstances of that individual. So it's not something that you can totally rely on or hang your hat on, but it does give a clue, a window into the IRS's intent and how they're looking at and dealing with this situation. And Private Letter Ruling 2005-19011 addresses the division of incentive stock options in divorce. Essentially, it provides a mechanism to allocate income from the exercise of incentive stock options between spouses. Both the income and the income tax will be allocated to and reported by the non-employee spouse for his or her exercises. Important to note that this also includes the AMT. So again, at exercise for incentive stock options, we have income for purposes of alternative minimum tax, but we have no income recognized, assuming no disqualifying disposition under the regular tax code. Incentive stock options cannot by statute be transferred between spouses, or they will result in a disqualifying disposition. Importantly, a designation of the non-employee spouse as the beneficiary of the share of community options in a trust agreement will not disqualify the options. So this really gave some clarification as far as the tax treatment and how to go about dividing options in the divorce process. Again, at the end of the day, you basically have the non-employee spouse steps into the shoes of the employee spouse, and the tax treatment flows down as you would expect, with the caveat that the FICA taxes cannot be divided. Now, there was another private letter ruling in 2007 that reiterated the same guidance, again, just providing affirmation of previous rulings. And this said that this allocated to the non-employee spouse the income and tax consequences of the share of incentive stock options that remain in the name of the employee spouse. So the only difference here, only wrinkle, was these dealt with keeping the shares in the name of the employee spouse. They weren't divided. The plan did not allow it to be divided, so it was placed into a constructive spouse, and again, the tax treatment was the same. This has also been reaffirmed in a private letter ruling in 2010 that dealt with restricted stock. This said that the division of restricted stock is a non-taxable event pursuant to Internal Revenue Code 1041 that Roger explained earlier. The income reported upon vesting can be divided between the parties, reported as income to the non-employee spouse on the Form 1099. And while it didn't deal with this in the ruling, it's likely that this will have the exact same treatment for FICA as non-qualified stock options. Moving on to retirement plans. Just want to provide a kind of quick overview of retirement plans and the ways for dividing the different types of retirement plans in divorce. We have qualified and non-qualified plans. Some examples of qualified plans include 401k, profit sharing, pension plans. Really, the term qualified just means that they qualify under key sections of the Internal Revenue Code, and as a result, they're eligible for special tax treatment, including IRA rollovers and deferred taxation. Non-qualified plans include different types of tax-deferred, employer-sponsored retirement plans that fall outside the scope of ERISA guidelines. Now, the difference is non-qualified plans are really designed to meet specialized retirement needs for key executives and other select employees. These plans are exempt from the discriminatory and top-heavy testing that qualified plans are subject to. So they allow an employer to provide specialized benefits or greater benefits without offering it to really the rank-and-file employees. Some of the major types of non-qualified plans that you may be familiar with include deferred compensation plans, executive bonus plans, group carve-out plans, and split dollar life insurance plans. For the most part, these contributions are non-deductible to the employer and taxable to the employee. However, they allow the employees to defer taxes until retirement, and they're presumably in a lower tax bracket. Because these are elections by the employee, it's important when looking at income available for support purposes that these are included as total compensation because, like I said, the employee has the option to elect to defer this compensation, which can come in the form of cash, bonuses, or equity compensation. Now, individual retirement accounts, IRAs, are not qualified plans. The best way to divide these is a direct trustee-to-trustee transfer from the IRA owner's IRA to an IRA established in the name of the non-owner spouse. By doing this, you eliminate any tax consequences that may occur if they were to be rolled over and then tried to move instead of a direct trustee-to-trustee transfer. There's no distribution to either spouse. It goes directly from one IRA to the other IRA and avoids any tax consequences. A QDRO is not necessary to divide these plans, and this applies for simple IRAs, SEPs, and Roth IRAs as well. Now, one thing to keep in mind is there is a way to take money out of an IRA before the age of 59 and a half and avoid the 10% early withdrawal penalty. Under Section 72T of the tax code, you can take money out of the IRA as long as you withdraw them with a series of substantially equal payments, and these payments must continue either until the individual turns age 59 and a half or for a minimum of 5 years, whichever comes last. So not something that's recommended in most cases, but it is an opportunity to provide liquidity in the event that an employee or that a spouse needs money now. Now, QDROs, Qualified Domestic Relations Orders, are a way of dividing qualified plans. There are several requirements that a domestic relations order must meet in order to be qualified. Essentially, a QDRO recognizes and identifies the alternate payee's right to benefits under the employee's qualified plan. So what are the requirements for a QDRO? Well, number one, it assigns to an alternate payee the right to receive all or a portion of the benefits payable with respect to a participant from a qualified plan. And it has been approved by the plan administrator. Keep in mind that every employer has specific requirements that they want a QDRO to contain. So it becomes really critical to make sure that the QDRO that's drafted is approved prior to finalizing the marital settlement agreement, so that you don't find yourself in a situation where marital settlement agreement spells out the division based on a QDRO that it turns out the employer doesn't accept for one reason or another. So who can be the alternate payee? Let's break this down. The alternate payee can be the participant's spouse, their former spouse, child, or other dependent. Now, one thing to keep in mind is that if the alternate payee is the spouse or the former spouse, then the distributions from that plan will be subject to taxation by the spouse or former spouse. On the other hand, if there's a child or other dependent that's named the alternate payee, well, the tax consequences from any distribution are going to fall under the employee's spouse. So that's really important to keep in mind if you're using this for purposes of child support or one of those types of things. Also keep in mind that a court order or QDRO cannot alter the way benefits are made under the plan. In other words, a QDRO cannot expand the rights of the alternate payee beyond what the plan allows. Now, it is okay for a QDRO to curtail the rights of the alternate payee under the terms of the plan, but it's not allowed to expand those rights. A key piece to keep in mind is that a QDRO should include provisions in case the plan goes bankrupt. Oftentimes with a qualified plan, there will be the Pension Benefit Guaranty Corporation that will take over the plan and provide some form of benefits. However, it often doesn't provide full benefits. So you want to specify in the QDRO how that's going to be allocated. Will it be on a pro rata basis, which is usually the way to go for the most equitable distribution. Another thing to keep in mind is that there is a planning opportunity for taking early distributions. This is slightly different than with an IRA, but the same concept. The early withdrawal penalty for taking distributions prior to age 59 and a half comes to 12.5% total, 10% at the federal level and 2.5% at the state level. Under Internal Revenue Code 72T2C, pursuant to a QDRO, the alternate payee can receive a one-time lump sum distribution without a penalty. So an example of this would be normally you'd have to roll it into an IRA, but the husband can keep some of that money, will still pay tax, but will not have to pay 12.5% early withdrawal penalty. This allows a one-time shot to inject liquidity, but keep in mind as soon as that money goes into an IRA, you lose the ability to take advantage of this strategy. Another thing to keep in mind when doing planning is that there will be a 20% withholding. So if you're looking and you need, and the non-employee spouse needs cash to pay legal bills or just to maintain the cost of their lifestyle, they are going to want to gross it up by that withholding to account for the withholding tax. Lastly, just wanted to touch on the Kiddie Tax. And so what is the Kiddie Tax? Kiddie Tax is a tax that's applied to your child's unearned income of more than $1,900. Unearned income refers to investments such as interest, dividends, and capital gains. The Kiddie Tax was meant to discourage parents from reducing their own taxes by shifting investments to their children, which are presumably in lower tax brackets. This applies to children that are under age 19 or full-time students under age 24. So how does this work? Well, this only kicks in when your child's investment income exceeds $1,900. And in that case, the first $950 is reported on your return, on the parent's return, is tax-free. The second $950 is taxed at the child's rate. Any unearned income above that amount is subject to the Kiddie Tax. In other words, the parent's marginal tax rate. Now, the custodial parent is the parent whose taxable income is taken into account in determining the child's tax liability. This is also the parent that's obligated to file the child's tax return. So this can be an opportunity where if the custodial parent has a lower income than the non-custodial parent, and there is some income shifting where the child has significant unearned income, you can find a bit of an arbitrage opportunity where you're able to convert from the non-custodial parent's tax rate to the custodial parent's tax rate on the child's unearned income. So what's the moral of the story? The moral of the story is that state law may indeed determine the rights to and ownership of property, as the divorce decree, settlement agreement, and QDRO provide in this case. The Internal Revenue Code will determine how those property rights, once established, shall be taxed. What that's saying is that the IRS has taken the stance that we're going to allow state law and community property law to govern the agreement in terms of ownership and rights of property. However, we don't want, the IRS is saying, we don't want to get involved in each person's dissolution. So what we're going to do is we're going to take a step back and we're going to apply those rules once determined based on the Internal Revenue Code, not based on what's spelled out in the agreement. So this is a mistake that we see frequently when we're reviewing marital settlement agreements, is that sometimes attorneys or individuals will decide to alter the tax treatment, and it can be fairly confusing to clients who see who read in an agreement what the tax treatment is going to be, and in effect, that's not what's going to apply. The IRS is going to apply the Internal Revenue Code to the agreement based on the ownership of property, but not based on the tax treatment as spelled out in MSA. So that's something just to keep in mind. And with that will conclude my section. So I think we can open it up to any questions.
Right. Or another way that I like to think of it is that every marital settlement agreement has three parties: the husband, the wife, and the IRS. We have to account for all three of them. So one question that came in, somebody asked a question about some definitional issues with respect to ISOs and NSOs. And keep in mind that a stock option, to be an NSO, has to be an ISO, an incentive stock option, has to meet a lot of requirements in the code. It has to be designated as an ISO. It has to be pursuant to a written plan that specifies a maximum number of shares that can be granted as ISOs. And importantly, it's only an ISO to the extent of $100,000 per year. What that means is that to the extent that an option becomes exercisable with respect to more than $100,000 worth of stock at the strike price per year, it's not an ISO, regardless of what you call it. It's an NSO. Would you like to add anything to that, Jason?
I think one thing to add is what may start out as an ISO and not violate the $100,000 limitation can change in the event of an acquisition. So if you have a double trigger where the company sets it up, designed for each of these ISO tranches to vest and not violate any of the $100,000 limitation, if there is an acquisition, that can accelerate some of the vesting or exercisability and result in something that may be unexpected. So it's important, especially if you're dealing with the out spouse, to educate them on some of these issues so that they understand that this is a risk factor, especially if there's, in this area with all the M&A that's occurring and picking up recently.
Right, right. Okay, well, I want to thank my guest, Jason Crowley, today, and I'd like to thank those of you who are out there on the line. Keep in mind that this webinar has been recorded. You will find it at royseuniversity.com. You will find the materials also recorded at the Royse Law YouTube site and available as a download in the iTunes Store. In addition, the slides and the materials will be available both in the PowerPoint and PDF form on Royse University, also posted on SlideShare, and a transcript of this webinar will also be available on royseuniversity.com. I invite you to join our mailing list. We do this at least every other week. We've got some very interesting webinars coming up on the new Obamacare health law. We've got webinars coming up on legal issues relating to trade secret protection, HR issues in employment, and some industry-related webinars coming up on Bitcoin, for example, that we're in the process of planning, as well as sustainable investing. So it'll be a very interesting summer and rest of this year. And with that, I'm going to conclude the webinar.